If the Fed cut the rate a half a point, then why is the real estate market stuck? As we know, the Fed finally cut rates last month by a half a point. So only to have absolutely nothing change in the housing market prices. So lower rates typically translate to lower mortgage interest rates, which should give buyers more buying power, right? And that's a good thing. But is it enough? Well, here's the thing. Some experts predicted that once rates hit 6%, home pricing would actually skyrocket, offsetting any relief from interest rate cuts.
Is if rates go down just another percentage point, that's what I'm hoping for by year, and prices are going to go through the roof. And the reason for that
would be around 6%, get to that level.
Because everyone will come out and buy. There are probably 10 buyers on the sidelines waiting for interest rates to come down that are actually active in the market. So everybody's going to charge the market. And so if you wait for interest rates to come down by another point, I don't think you'll gain. I think you'll wind up paying more, because I wouldn't be surprised if real estate went up by another 8 or 10% if interest rates come down another full point.
Yet according to Freddie Mac, the 30-year weekly mortgage interest rate as of September 19th, 2024 was 6.09%. And yet we're not seeing those buyers flooding the market, causing prices to spike 8 to 10%. So if lowering interest rate won't make a difference, what will it take? And today, we're going to examine what's really needed to impact the housing market and the housing crisis that we have right now. We're going to discuss where interest rates might actually be heading through 2025, because that is an essential piece of the puzzle for sure. Rates going down is a start, and we hope that trend continues, but is it enough? So we're going to look at Samantha Dell's CNN article titled America's Home Affordability Crisis Has a Solution, Lowered Rates Isn't In. And Moody's Analytics economist Nick Villa, his analyst, which argues that America needs more affordable housing, not just high-end inventory. Despite the recent mortgage rate declines, remember, we went from 7.25% back in April of this year all the way down closer to 6% in September. And now the rates have kind of creeped back up all the way almost to about 6.5%. So despite the mortgage rate declines from earlier this year, there's been no corresponding increase in loan applications or consumer home buying sentiment, according to Doug Duncan, Fannie Mae's chief economist. Even Jerome Powell admitted that simply lowering the rates, well, that won't open up the housing market itself. The real issue is a shortage of housing, which isn't something the Fed can fix themselves. So yes, by getting inflation down and the housing cycle normalized, that's the best really they can do for households. So the supply problem will have to be addressed by markets and government policy. So Powell also acknowledged that while the Fed can influence the housing market by adjusting rates, they can't force people to sell their homes. So until rates really drop below 6%, or ideally in the perfect world, closer to 5%, the lock-in effect is going to continue to restrict inventory. Existing home sales hit a nearly 3-decade low last year across the country, with the recent National Association of Realtors data showing a 2.5% drop in August from the previous month and a 4.2% drop year over year. The shortage of homes for sale and rising ownership costs such as insurance, property tax, and just the maintenance overall of the home makes it a lot harder and difficult to actually afford a home. While the Fed's rate cut was definitely good news, there's so much more that needs to be done to address this unprecedented housing crisis. So Moody's economist Nick Villa suggests that the real need is more diverse housing supply, right? Building more homes is part of the solution, but the properties that actually need to be built to target various price points, well, it can't just be the luxury market. And over the past 25 years, the luxury, what they call the Class A multifamily units, have grown by 18%, now making up over 50% of multifamily housing, while mid-tier Class B and affordable Class C units have dwindled. And that's where a lot of your buyers and people who can afford to buy are currently in right now. So according to Elena Booz in Fortune, Class B apartments are older but well-maintained, while Class C, what those are, they're older and often charge below market rent. Now, these types are essential because not all Americans can actually afford to buy Class A units, which again have increased nearly 19%, while Class B and C growth was only 2.6% since 2019. So it makes sense developers would focus on high-end properties as they yield higher rents. And with Class A rents 45% higher than Class B and Class C, you can't blame them. Moreover, an increase in high-income households has fueled luxury construction. The Census Bureau notes that households making over $100,000 rose from 31.9% in 2000 to 37.5% in 2022. But Villa stresses that we need all types of housing. Instead of drill, baby, drill, like they say, maybe it should be build, baby, build. So look, the issue isn't just about rates, according to Dushka Nara Skillington of the National Association of Home Builders. Builders are still facing labor shortages, regulatory costs, zoning restrictions, right? Nobody wants new construction in their neighborhood. And of course, still expensive materials. So builders actually have over 250,000 open jobs right now, which previously peaked at 400,000. So even if rates fall, other issues really hinder the housing supply expansion, making affordable housing a challenge. So until mortgage rates actually reach that 5 to 5.5%, we likely won't see relief from the lock-in effect. Wells Fargo senior economist estimates the 30-year fixed mortgage rate will reach 5.5% by the end of 2025, which could ease supply constraints. Moody's also projects mortgage rates, they will probably drop to about 5.5% by 2025. And the Mortgage Bankers Association, they predict 5.9% by 2026. And Fannie Mae projects a decrease to about 6% by this year's end, down to 5.7% by 2025. And in order for them to be able to hatch, right now, remember, the rates are currently sitting closer to about 6.5% as rates have trended upward over the course of about the last few weeks. All right, so Jerome Powell notes that as rates fall, people start moving more, but sellers often become buyers in the same market. So it's unclear whether that would add significant demand. And with the upcoming election, both candidates are addressing the housing crisis with their own alleged policies through their approaches, and obviously it varies from one candidate to another. So we'll see what happens in the next coming months. So what do you think? What's your take on the housing market's future? Real estate is quite localized, so tell us what you see in your area in the comments. So as we wrap this up, let's check the latest data from Redfin. New listings rose by 5.1% year over year, with active listings up by 16.1%, the smallest increase since April. And while 34.4% of homes sold within the first 2 weeks, that's down from 38% last year. So median days on the market increased by 6 days to 37, and homes selling above the list price dropped to 27.5% from 32% last year. But that's national. What's really going on here in Los Angeles? Well, what we're seeing almost county-wide is that here in Los Angeles, the inventory is up almost about 40% county-wide since this time a year ago. And pending sales are down about 27% from a year ago. Now, I love the zip code 91326 because this is a zip code that has properties that start off in the 500s, high 500s, and then go all the way up above 4 million. So you have everything in between. So it really encapsulates almost every price point here in Southern California. And we're seeing the same thing, right? Back in February of 2024, you saw inventory at 34. Now you're looking at 94. So you're essentially almost looking at a 300% increase in inventory. So that's just number one. Number two, in the higher end price points, just here in 91326, and you're seeing this play out countywide, is the fact that homes over 1.5 million, those are the homes that are sitting because all the buyers tend to be under 1.5. That's just where the majority of the buyers are. So in fact, here in 91326, you have currently about almost 45 properties for sale that are over 2 million. Guess what? You only have 3 in escrow while at the time that we're actually shooting this video. So that gives you a really good idea of what's taking place right now. So right now, we're kind of seeing that market stuck a little bit. So if you're not priced correctly as a home seller, then you're going to be sitting on the market. And one thing I really want to point out, because a lot of home sellers are having a real difficult time understanding this right now, is that let's just say, for example, that the recent comp, the home down the street from you sold at 1.1 million. There's a really good chance that you might have to be 3 to 5% under that 1.1 million just to get activity on your home. So a lot of homeowners are struggling with that right now. Now, that being said, homes are still selling, but you have to be priced correctly, right? You as the seller have to take into effect how the market is affecting the buyer right now. All right, any questions about this video, any questions about real estate here in Southern California? Always glad to be a resource. Hope you enjoyed this video. I'm Scott Himmelstein with the Scott Himmelstein Group, and we'll see you on the next one.